Welcome back to Talk Tickers. This is the show where we strip the earnings call down to the absolute studs to find the raw data and, the tradable signals. I'm your host, and today we are turning our radar to the skies. We're breaking down Q4 2025 for United Airlines, ticker UAL. And honestly, this feels aggressive.
Oh, it's incredibly aggressive. I mean, you just look at the tape. The market is absolutely buying it. United shares are up, 251 to close at 111.08.
That's a 2.31% pop.
Not bad, bad at all.
Yeah.
But you're right. The price is almost secondary to the tone. Management didn't just say, hey, we had a good quarter. They framed this as a strategy validation moment.
Okay,
a victory lap. But looking at the headlines, the last quarter wasn't exactly smooth sailing. I mean, we had a massive government shutdown, FAA directives.
Yeah.
Chaos, right?
That is exactly the paradox. They had this huge operational headwind, yet they're claiming the high ground on premium revenue and, frankly, declaring war on their competitors in Chicago. Okay, a war in Chicago. We have to get to that. But first, let's ground ourselves in the raw numbers. Yeah. What did they actually print?
Let's do it. Headline numbers first. Adjusted EPS earnings per share came in at $3.10.
And the street was expecting.
Consensus was around $2.94, so they beat by a solid 16 cents.
16 cents. Is that a blowout or just good housekeeping?
In isolation, it's a solid beat. But then you look at the revenue number, a record $15.4 billion for the quarter, up almost 5% year over year.
Okay, that's strong.
But the real kicker, the reason the stock is moving isn't Q4. It's the guidance. It's always the guidance. Markets look forward.
The forward look, what are they steering towards?
They guided full year 2026 adjusted EPS to a range of $12 to $14.
12 to 14. And where was the street on that?
The street was sitting around $13.19, so United is basically standing up and saying, we're going to make way more money than you think we can. They also see Q1 coming in hot, between $1 and $1.50 per share.
Okay, so they're raising the bar. But back to that paradox you mentioned, the government shutdown. How do you beat earnings when travel is a mess?
That's the nuance that makes this so impressive. It's what we call the clean number argument. You have to remember, that whole shutdown mess cost them about $250 million pre-tax.
Wait. Just to be clear, if the government had stayed open, they'd have made an extra $250 million.
Exactly. They beat the street by 16 cents while eating a $250 million headwind. So you strip out that chaos, and the underlying profitability is just massive.
It signals the core engine is running really efficiently, even on a bumpy road.
Right. And if the government stays open next quarter, that money just flows straight to the bottom line.
Okay, speaking of the engine, what about the balance sheet? Is airline debt still a concern?
Far from it. This is a deleveraging story now. Their net leverage is down to 2.2x.
Which for a capital-intensive business is pretty good.
It's very healthy. They paid off $1.9 billion in high-cost debt this past year alone. They're cleaning house.
So what's the goal there?
The CFO was explicit on the call. They are gunning for investment-grade ratings in 2026. They want that blue-chip status back.
Okay, so financials are solid. Let's dig into this strategy validation idea. They kept using the phrase, no excuses culture. What does that actually mean for an airline?
It's about how they pivoted during the crisis. When the shutdown hit, a normal airline response would be to just cut flights across the board, shave 10% off everything.
Spread the pain equally.
Right. But United didn't do that. They prioritized. They were ruthless. They cut the low-margin regional and non-hub domestic routes. But they protected the crown jewels, long-haul, international, and hub-to-hub connectivity.
So they sacrificed the small fish to save the whales.
Precisely. And the data backs it up. Despite the chaos, they had the highest seat completion factor of the big three. They actually flew the planes they said they'd fly.
That's impressive on its own.
But here's the stat that honestly blew my mind. During the shutdown, they recorded the best net promoter score in the company's entire history.
Hold on. NPS. That's customer satisfaction, right? Like, would you recommend this?
Exactly. The gold standard.
So you're telling me when airports are a disaster and people are stranded, United's customers were happier than ever. How is that possible?
It sounds totally counterintuitive.
Yeah.
It came down to how they handled the bad news. They offered refunds even on those non-refundable basic economy tickets. They were transparent. They bought goodwill instead of hiding behind the fine print.
That is not the airline experience most of us know.
No, it is not. And you'd think all that scrambling would blow out costs, right? Over time, hotels. But their CETAS MX was up only 0.4%.
Let's decode that. CSMX.
Right, sorry. Cost per available seat mile, excluding fuel. It's the best metric for judging how efficient management really is.
Yeah.
And keeping that flat during a crisis is it's incredible.
How'd they pull it off?
They're crediting technology investments. Things like automated tech ops modeling. Basically, using AI to predict maintenance issues before they happen. It keeps the planes flying.
So it's structural efficiency, not just cutting costs.
Exactly.
Okay, let's pivot to revenue.
Yeah.
I'm seeing a trend in the notes that looks a lot like the K-shaped economy.
That is the perfect way to describe it. The split between the front of the plane and the back of the plane is the story of the year.
What's the divergence?
Premium revenue first class, Polaris up about 12%. Loyalty revenue from the credit cards up 10%.
On the back of us.
Main cabin, the standard and basic economy seats. That revenue was actually down about 5% for the full year.
Wow. So the cheap seats are getting cheaper and the expensive seats are booming.
It proves their strategy of chasing the high-end traveler is working. Management's whole thesis is that they're inoculating themselves against price wars. You know, if a low-cost carrier wants to sell a $29 ticket, United doesn't have to follow them into the gutter.
Because the person buying a $4,000 business class seat isn't cross-shopping with Spirit.
Exactly. Their core customer is locked in. It protects the margins. It builds a moat.
Okay, but what about business travel? Is that back? The death of the corporate road warrior was supposed to be permanent.
Greatly exaggerated. United gave a really clear signal here. They said business travel in January 2026 is starting incredibly hot. Volumes up nearly 20% year over year.
20%? That's a huge jump.
It is. And remember, corporate travelers are the most profitable passengers. That is pure margin expansion dropping to the bottom line.
What about geography? How's the rest of the world look?
Atlantic and Pacific are stars. Our ASM revenue per available seat mile is positive in both regions. Europe and Asia are strong. The only real soft spot is Latin America.
The Caribbean is soft. Why?
They pointed to some geopolitical stuff, specifically involving Venezuela, that's spooking some travelers in the region. But they see a path back. It's a blip, not a long-term trend.
Okay, so now I want to get to the part of the call that felt less like an earnings report and more like a mob movie. The Chicago War.
Yes. Scott Kirby did not mince words.
What's going on at O'Hare?
This was the highlight of the call. Kirby drew a literal line in the sand. Chicago is a fortress hub for United. But their main competitor, they didn't name them, but it's American Airlines, is also huge there.
And they're going head to head.
And according to United, they made a $500 million profit in Chicago last year. In the same breath, they implied American lost $500 million.
United made $500 million, American lost $500 million in the same city. That is $1 billion swing.
$1 billion swing. And despite losing money, American is aggressively adding capacity. They're trying to win back 3 gates in 2026.
And Kirby's response?
Total war. He explicitly said United will not lose a single gate, even if it means saturating the schedule with flights. He basically guaranteed a capacity war. He called it economic gravity.
Economic gravity. Unpack that for me.
His argument is pure math. He believes American's operation in Chicago is structurally unprofitable. And he predicts that if they keep fighting, their losses there could balloon from $500 million to $1 billion in 2026.
So she's saying, go ahead. We have the cash. We have the premium flyers. We will bleed you until you retreat.
That is the strategy. It's high-stakes poker with 737s, and it tells you just how confident United is right now.
That's incredible.
Huh.
Okay, shifting gears. Let's talk nuts and bolts, literally. The supply chain. It's not about pilots anymore. It's about engines, right?
That is the bottleneck of the decade. Kirby said there are roughly 800 aircraft grounded globally right now, not because they're old, but because there are no available engines for them.
800 planes just sitting there.
Just sitting there. And for an incumbent airline like United, this is actually good news.
How is that possibly good news?
It's a natural cap on industry supply. Basic economics. If supply is constrained and demand is high, prices go up. United is getting their planes over 100 narrow bodies next year, and they can keep them flying. So as the industry struggles to grow, United can take share and charge a premium.
Scarcity drives value.
Yeah.
Okay, one last thing before the trade idea. The Credit Card Competition Act. Is that a threat?
The CEO was pretty dismissive. He argued United's cardholders are high FICO score, low revolve customers. They're sticky. They're tied to the airline. He thinks their portfolio is much safer than, say, a generic cashback rewards program.
So the loyalty program is another fortress.
Exactly.
We should also quickly mention the executive shift. Glenn Hohenstein is retiring.
Yeah, that's huge news inside the industry.
Oh.
He's an icon, the architect of the modern airline revenue model. But Kirby framed it as him leaving on a high note. The machine is built, it just needs a new operator.
All right. We have covered a lot. The numbers, the K-shaped cabin, the Chicago war, the engine shortage. Let's try to turn this into something actionable.
Let's do it.
Okay, disclaimer time. This is not financial advice. We are two voices on a deep dive, not your financial advisors. Please, do your own diligence.
Seriously, don't trade your rent money based on what we say. Do your homework.
All right, with that out of the way. If I were a hedge fund analyst pitching my investment committee today, here's the trade I'd pitch. I'm calling it the O'Hare straddle.
The O'Hare straddle. I like it. Walk us through it.
The classic long-short pair trade.
Yeah.
The long side is obvious. You go long United, UAL.
Your rationale.
They're the profitable incumbent. They have the premium traffic, the better tech stack, and they're printing money in a supply-constrained world.
Okay, that's the long. Simple enough. What's the short?
You short the Chicago competitor. You short American Airlines. AAL.
Bold. Why?
Because of the war we just talked about. Scott Kirby just guaranteed a capacity dump in Chicago. United has the balance sheet to win a burn rate battle. American is already losing $500 million there. If that balloons to $1 billion, that is going to crush their margins.
So you're betting on United bleeding the competition dry until economic gravity forces them to retreat.
Exactly. It's a bet on the stronger balance sheet winning a war of attrition.
I like the logic. Is there a kicker to the trade?
There is always a kicker. The wild card is you buy calls on MRO providers.
MRO?
Maintenance, repair, and operations. Companies like AAR Corp or HIIO.
The engine shortage? I see where you're going.
Exactly. If 800 jets are grounded globally waiting for engine work, who has all the pricing power? The guys holding the wrenches. Demand for engine overhauls is going to be through the roof. It's a derivative play on the supply chain failure.
That's smart. If the planes aren't flying, they're being fixed, and fixing them is not getting cheaper.
Precisely. So to recap, UAL delivers a beaten raise in a chaotic quarter. Premium is king. Chicago is a battlefield. And the engine shortage is the moat that keeps prices high for everyone who can fly.
A very, very strong showing from United. They controlled what they could control and capitalized on the market's flight to quality. It's a compelling story.
It certainly is. Thanks for tuning into this deep dive. Keep your seatbelts fastened and your stops tight. We'll catch you on the next Brent.
See you next time.